Welcome back. This is Chili Davis, and I'm back to do another video. Today's topic, we're going to talk about price targets and why they matter. Half of the topic will be about entry price point, and the other half will be about exit price point of the stock. So real quick, I want to welcome back all my subscribers and welcome to my new viewers for stopping by the channel. This is the channel where we talk about my top stocks, and we also talk about a lot of other wealth building strategies as well. But today we're going to talk about 4 or 5 stocks, and we're going to talk about price target. So about 3 years ago, 2018, I was studying stocks, and I found about this fund called ARK Fund. Many of you may know Kathy Woods, and she's real popular now. But here's the thing. Whenever you start to buy a stock, you have to analyze what your monthly performance is, what your annual performance is, and then what your 3-year performance is. So I have ARK Fund up here, and I think ARK Fund is running out of gas. Back in 2018, I'm going to go back a little bit. I pulled up 2 charts. One chart was, ARK Fund, and the other fund was Facebook. So we'll go back to 2018 on Facebook. And what I realized was from 2017, let's go back to 2018, I was getting the same return. So let's just say 2017, the stock was trading about 170, and 2018, the stock was trading about 200. So I started seeing there was like, okay, there's 20% or there's a 30% gain. And it was the same with the ARK Fund. I looked, I said, well, looked at the stock, and oh yeah, this is exactly what I was looking at. 2017, the stock was trading at $57, and then 2018, the stock was trading still at 50 something dollars. And even if we look at because there's all kind of ARK funds, let's do RK. Some of them perform a little better than the others, but it's the same pattern. So what I had to understand in my mind was that, am I getting 20% from an ETF, or I'm getting 20% from a Facebook? And I realized that I was getting the same potential that I was getting from the ARK Fund, which felt more safe. It's got, more diversified funds in it, so you feel safe. But once I realized I'm getting the same return from my ARK Fund here as my Facebook fund, I decided that I was going to start trading single stocks. And then it became easy because it became predictable. So we're going to talk about price entry point. The next stock, 2019, I decided, okay, I'm going to get into Microsoft. Yeah, it was about 150. It was like December 150. And my goal was for Microsoft just to hit 170 or even 200. So my goal was, if I pull up my calculator, and 150, so 170 minus, no, we're not going to, we'll even give myself a little better. 190 minus 150. All right, so 40 over 150. My goal was a 26% profit margin. So in 2019, when I looked at Microsoft at the end of the year, I said, okay, my goal is to get the stock at 150 and exit at 190 and make a 26% profit. Well, I did that. I mean, basically I got in and the stock went to 187. So that was phenomenal. But then when I realized after that, I said, well, I'm going to keep letting this thing go. And, of course, fortunately, Microsoft was the right now best stock, and I doubled my money again. So I mean, it's like by accident I doubled my money, but my actual price entry point is really conservative. I try to enter the stock at a point where I know that I'm going to make 20, 30%. So that's how I buy stocks. Again, I doubled my money on Octa, and same kind of pattern. I got in stock about 86 or 90 something dollars, $90, maybe 91, whatever, somewhere around there. But what I did was with this stock is I said, okay, what is the possibility of this stock doubling? And at the time I was like, well, I think it could double. And, lo and behold, it did. But I talked about how you can enter a stock, but you also have to know when to get out. So we're going to look at, okay, Okta, I got in at 90 something dollars, $90. And my goal was only for it to hit like 130. So it's really easy to do 30 times 100. And that means you're just going to get 30%. So it was really easy to say, okay, when it gets to 130, I'm going to get out. But guess what? Again, I didn't get out of the stock because it was like, well, I'm making money. So I was like, so, and the other aspect when you say, okay, I'm making 30% of my money, that's 30% on 100, it's $30. That's pretty good compared to a bank. I don't know any bank paying more than 8% a year, and then in savings. And the only time they do that is if you give them a large chunk of money. So I don't know any bank giving more than 8% annual. So that's why I'm into stocks. And like I said, all you have to do with stocks is figure out what your price target is and say, hey, if a stock is $100 and I want price target of 30%, I do 0.03, that's it. And then you have to decide how many shares of it. So if you want to make, $300, you have to buy 10 shares of, $100 stock, which is you have to invest $1,000. So all this is, like if I have $1,000 invested and I do 0.20, and I make 20% of my money, which is $200. Or I do 0 times 0.10, it's $100 on my $1,000. It's the same pattern. Now, what do we do after the like in this case, the stock, I got in at 2019 at $100, and later on that year, or the stock doubled to 200 and something dollars. In July, this stock Okta doubled to 200 something dollars. Well, at that time, you sell half and you keep half. So if you let the stock ride past 30% or 40% or 50%, what you want to do as soon as you get past that 100%, you want to sell half of your shares of it. So if you had 10 shares, you want to sell half of the shares, because obviously, like from here on, this 220 to this 260, it's not that big of a difference. Let's say 220 to 260. So let me show you what that is. 220 minus 260. $40. So $40 on 220. All right. So now, once you hit a certain point, okay, this is 20% gain from 220 to 260, the current price. You start to hustle backwards. See, So the maximum potential on this stock was from $100 to $200. That's where all the money was on this stock. And you have to do that in these stocks. You can't just stay in it forever, because at some point it starts not necessarily go backwards, but you're making minimum gains. So this is like wasting capital, because the money sitting here at 220, 240, you know, up here, you're only going to gain 20% on it. So now you're not going to be able to get that 80% gain that I got 2 years ago, right? So my current stock that I'm focused on is Domo. Domo is a data company, and they work with some serious partners, ESPN and Target. And again, the same pattern. I got in the stock February, let's see, December, I think it was. 2019. Got in the stock. Oh, $20 per share. And now I'm at a point where the stock is almost $100. So let's just do the math so everyone can see. Okay, current price is $96 minus $24. We're going to be really nice to myself. $72 divided by $24. And I 3x my money. So what should I have done on this stock? Truly, I should not have necessarily 3x my money. I should have, let me see, I got here, stock broke down there. Okay. This was March of 2020. When the stock got back up here, so it was $8. At $46, I should have been taking profit. Why? Because even at $46 minus 24, it's just being conservative, it's still $22. I doubled my money right there, right? And then let the rest of it ride. But actually, I didn't take profit. I'm still holding Domo when I bought it at $24 per share. So my point of this video was just to explain, when you're going into buying a stock, go in with a price target, whether it's 20%, even 10%. That may be your goal, just to beat the bank. You know, I'm going to make 10% on my money. And then your next goal might be 20%. Your next goal should be 30%. But always be, you know, looking to sell some and take some profit. That way you're getting your consistent returns, and you could go to sleep or, you know, rest for sure that you're making money in the stock market. So I want to thank you for watching. Thank you for listening. And please like, share, and we'll see you on the next one.